Ron says, I have collars on SOFI. Let's go back to the married put search. So he might have standard collars, but let's assume he's got some married puts, longer term puts with calls sold against them like we showed with my Alamos Gold position. So SOFI, NVDA, Apple, PLTR, most of them have pulled back a little, so my calls and puts are getting more profitable. NVIDIA is not as profitable because at first it took off and I was rolling my calls and puts up for losses. Guess I should have stopped selling the calls. And that's my next step, Ron. And you're absolutely right. So what are we talking about here? Let's just take SOFI right now. This was one of the ones you mentioned. SOFI is currently at 26.54. That's really deep in the money, though, for me. It's 16% in the money. I usually like to be in this 12, 11, 10% range, but let's stick with SOFI because it's one of yours, and I could use NVIDIA as well. It's an 8.4% risk, only 3.7% in the money, but I'm going to stick with SOFI. 26.54 right now. March 31st put. I'm sorry, 20th of March, 31 strike put. Midpoint may or may not get that. It's at 745. I think the market maker would push me closer to this $8 level, but it's at 8.8% maximum risk. Let's take a look at the profit and loss chart. So here we go. I'm going to use the scrubber down here to expand it a little bit. You have 30 put calls on SOFI. That's great. So that's working in your favor. Ron, as he said, just like me, at one point on SOFI, he might have had the 30 call being threatened and the put was losing value. But with the pullback of the last couple of days, the puts actually gotten more profitable. The calls, sold call he has is more profitable as well. The first instinct that most new investors have when they take a look at this married put approach is to say, okay, I get it. You're controlling risk to 8.8% to 154 days. Again, caveat, my thoughts, a little bit too deep in the money for me on this, but a little bit more volatile. If I have the feeling, why would I do a married put? What is the expectation when I open a married put? You've heard me say this before. Well, I expect the stock to move up 3 to 6% in the next 20 to 40 days, and then potentially another 6 to 8% in the following 60, 75 to 90 days after that. That's my expectation when I open a married put. Here we are roughly at 5 points, 4.5 points in the money, 16.8%, 4.5 points in the money, 16.8% as we saw. So I'd have to be pretty bullish on this one to consider this in my favor. And Ron, I'll get to that in just a moment as well. Now, the first thought is, okay, so instead of doing a covered call, Mike, which, can be used, are a viable source in the money covered calls, are a viable source of a conservative, consistent income strategy. Of course, we cap the gains. I might use an ITM covered call, looking for the higher probability of being assigned. I'm not married to the stock long term. I'm looking for it to hold or stay up for the next 7, 15, 30 days, get assigned, make the 1, 2, 3% return of assignment, and then use the search tool to find new in the money covered calls. It still have that 70, 75, 80% probability of being assigned, making that return. We might call it hitting singles, small ball. I'm not looking for the power move. I'm not looking for the large gain. It's good, consistent income with some conservative approach. However, what is the one thing the covered call is missing? You're only protected with an in-the-money covered call. Let's say our stock price is here. I'm only protected by the difference, the intrinsic value I collected, and whatever little time value. If it moves down below that, then risks can get out of hand. We all know that. We've all seen it. We've probably all traded. Covered calls is still, throughout all brokers, the most popular option strategy. Because even if you're a little bit more bold, you're applying 70 to 80% of your portfolio to long calls, 0 day to expiration options, credit spreads, and you consider yourself a spread trader, somewhere in the background, you've got stock that you've owned for years that is probably priced 20 to 30%, 40% lower I'm sorry, is priced 20 to 30, 40% higher than when you got in. And you're just generating out of the money income by selling out of the money covered calls just to act like a second dividend or an extra dividend on the position. But you're still trading covered calls on those few positions. And brokers just see who in these accounts are trading covered calls. And it's a lot of people. It's still the most popular strategy. Cash secured naked puts sometimes balance out with that, but they're parity trades of one another. It's a way to get into a stock at a cheaper price, of course, and then convert it to a covered call. The wheel strategy that's referenced from time to time, that approach as well. Now, why am I going into this when I said I wasn't going to go into different rabbit holes and things of that nature? The first instinct of someone who sees this news says, okay, well, I bought stock at 26.54. I think it's going to move up 3, 4, 5% in the next maybe 30 days. And I've got my 31 put here, and I've got an 8.8% risk. It's a little bit high. Let me just go ahead now. I've got weeklies available. Let me go to Halloween. Let me go 2 weeks out in time. And let me just sell a 30 call. Maybe 29. Hey, let's get $1. Let's cut that risk down by $1, $1.13. I'm selling the 29 call. Got my 31 put, got my stock at 26.50. My maximum risk was $2.99. Let me cut that down by $1 right now, about a third of that, a little bit more than a third. By selling this call right now, I'm going to reduce this 8.8% risk, no problem. Wait, what happened? We had a max risk of $2.99 or 8.8%. Why did it go up to 11.7% and $3.86? You did decrease the risk to the downside. You increased the risk to the upside. Your total cost basis initially was $32.86 plus $113. But now after selling this call, yes, your cost basis is $32.86. You have a 31 put. So, hey, I've lowered my risk to $186. That's great from the $2.99. But you've obligated yourself to deliver shares of stock at $29. There's the $3.86. Because if the stock shoots up, and I'm not saying it will, but if for whatever reason the stock shoots up, exceeds your expectations, moves up to $36, $37 per share in the next 14 days, just like a covered call, you've capped the gain. What happens when the stock's up here at 36? As we talked about before, your call is going to a delta of 1. Your put is dropping. The delta of the put is dropping to, as we mentioned, close to that 0.5, 0.4% range. But you're getting no positive delta on the stock anymore. That's countered by your short call. That's the problem, is the short call. It's not the put that's losing value. That's not the issue. You can still manage that. It still has time value remaining on it. It's the short call that's in trouble land now. That's when you're going to have to look to manage and roll. And that's what Ron was talking about. Now, Ron set these up more correctly. He doesn't have the 31 put. He's got a different put. He's got a 29, 30, 27.50 put on SOFI, and he's got the 30 call. Might even have the 30. Oh, 30 put and 30 call. Thank you, Ron. So, but that's not a new position. He's been managing it. But even in this scenario, and this is what I'm going to do with Alamos Gold. I'm not going to show it here because I would never recommend doing an income method right away. And in the various income methods we have, including 5 and 6, we're going to look at 6 in just a moment, the riskless spread trade. I typically don't do that right away, even though it offers benefits. What am I talking about? Let's go back to my portfolio. Let's go back to the Alamos Gold position. We know we have the stock. We know we have the call that expired worthless today. So let's just record that. Now I could simulate buying back the October 35 call. I could add it back in, put in that I'm buying it for 0, but we're not going to do that. What we're simply going to do is take a look here, and we're going to subtract 95 cents from our stock purchase after other income methods have been done, other rolls have been done. So we've got a stock basis of $26.48 minus, oops, sorry folks, our 95-cent premium, and this isn't the actual trade. Like I said, it was 85 cents, 80 cents, I think, that I got for this call, but I think it's actually the 36, not the 35. Difference of what's shown in Fusion versus what's shown in the webinar account. But 26.48, of course, minus our 0.95 cents drops us down to a cost basis of 25.53. All right, so let's just take that out and put in 25.53. We're going to clear out the 35 call. Go ahead and submit that. All right, so I still have in this account, I think Alamos Gold is bulletproof, by the way, in the Fusion portfolio. But here, we're still showing a risk of 1.4%. Holding the 28 put, which would be rolled up, of course. It has been. But in this case here, I would roll up the put. But let's say we just want to sell a call. We want to keep that income method number one. Alamos does not offer weekly options. So we'll go to November, and we're going to go right at the money at the 35 strike. All right, so we're going to get $2 here. We're going to bulletproof this trade. Let's go ahead and sell that. Get $2 for the premium. Bulletproof to 6%. Max return at 32.9% if the stock was trading right at our sold call strike at 35. And let's use that scrubber here to expand a little bit. Anytime you think the profit and loss chart is too tight, just go ahead and expand it. Now, Ron had mentioned SOFI, Apple, NVDA, and that he had been rolling the calls, and he's moved up to the 30 call on SOFI. And he says, eventually, I should stop selling the calls. Well, there is an alternative, Ron, of course, and that's income method number 6. Now, I was able to bulletproof this trade to the downside. 6% guaranteed profit in this example. Potential to make 33% if the stock's trading right at 35 days from now. Where are we going? What are we coming into? What did we just see last week? Who announced what? That's earnings. So let's go to stock research. Remember, I had to go out to November because Alamos doesn't offer the weeklies. October 29th, after market, Alamos Gold is going to release its earnings. All right. So I've got a position here that's bulletproof through earnings. I'm very excited about that. Even if Alamos Gold collapses down to $20 per share, $18 per share, we guaranteed to make 6% profit even after our adjustments with a cost basis of $25.53. That's perfect. I love that. I could double that by rolling up the put using income method number 4, one of the other income methods. But I'm going through earnings. I have to use November options because that's all that Alamos offers. Income method number 6. I'm still going to sell our 35 call. But at the same time, we're going to go ahead. I want half. I'm going to go half run. I'm going to buy a 38 call. I'm going to take half the premium away, which will still leave me in bulletproof status if I'm not mistaken. But what does this do to my position? There's great numbers to work with here. Selling this one for 2, buying this one 3 points higher for 1. I keep a bulletproof status of 2.2%, but I left the upside open in case of an unexpected spike gain in earnings or another comment that comes out about tariffs or anything else of that nature. If the market falls, remember this is gold, so if we go back to 37, I'm in a plateau here, but if we go back to 37, 38, 39, I've left the upside open. How? Well, remember, we had a long stock position. Let me give myself more space. That's a terrible drawing. We have a long stock position that we protected with a married put. And as Ron mentioned, now we have all green. We can't lose on this position. We are bulletproof on this trade. Now, at the same time, I sold a call here, just as we saw would have created that sort of collar position that we were in before. Peak profit here at the short call strike price. Tails off at the end because once it goes in the money, the delta of the shorter term call is getting closer to 1. And it's -1 because we sold it, countering positive delta of 1 we have on the stock, and our put still has a delta of maybe -0.4 or 0.3, somewhere in that range with what we're looking at here with that lower strike put. Okay, now we bought a call. We own a call at the 38 strike that we were paid to own. We did, Ron says. That's what income method number 6 is. I sold a 35 and bought a 38, which is a bear call credit spread. We sold the 35, took in $2, bought the 38, and paid 1. So I love the way this math works out. And it's not going to be this way on Monday, but I'm kind of liking these numbers here. But in any case, sold the 35 for 1. Mike, sold the 35 for 2, bought the 38 for 1, got a $1 net credit, which bulletproofed our position. But in actual trading, if the stock's above 38, what do I lose? I lose $3. I have to cover this obligation because the stock went in the wrong direction. But when you own the stock, your broker sees this as a covered call with an extra long call. I still might be assigned stock at 35. That is a potential outcome of income method number 6. But if that earnings exceeds expectations, using this extra long call that I was paid to own gives me infinite upside profit potential. And yes, as Ron, you mentioned, it's a pretty sight when you see all green on the profit and loss chart. The bulletproof trade, using the income methods against the married put position to lower that initial at risk and potentially bulletproof the trade. So that's what I'm considering with Alamos. Again, it depends how the market's open on Monday a little bit. But we know that call is expired worthless. I know where my position stands. It is in bulletproof status right now. I could sell the 35 November call knowing earnings are coming up at 10:29. If I don't want to cap the gain, which I don't think I want to do, I'm going to apply that other adjustment, add that extra call there to make it income method number 6, leave the upside open, keep in bulletproof status through earnings. And again, the actual radioactive trade is a little bit different. The put is higher and it is bulletproof. The cost base is a little bit higher. But income method number 6 is likely what I'm going to do on AGI going through earnings. If AGI opens up on Monday at 36, 37, or 38 for something that happens over the weekend, oh yeah, we're just going to do a 40 and a 42 bear call credit spread income method number 6.